Investing in dividend stocks is one of the best ways to grow your wealth over time. Dividend stocks are stocks that pay out a portion of their profits to shareholders as a dividend, typically on a quarterly or yearly basis. In this video, we'll explore 5 must-have long-term stocks that will help you increase your dividend income. From blue-chip stocks to sector-leading stocks, these investments will provide you with strong returns and steady income. So, before we start, kindly subscribe to our channel and turn on notifications so you don't miss any of our future videos. Number 1. P&G. The Procter & Gamble Company appears to be a good choice for investors looking for reliable and consistent income thanks to its solid dividend history. This company has once again awarded investors with a 3% hike in its quarterly dividend. The recent hike takes the dividend to 94.07 cents a share, which will be paid out on May 15, 2023, to shareholders of record as of April 21, 2023. This hike in dividend is also applicable for Series A and Series B ESOP convertible Class A preferred stock stockholders of record as of the start of the business on April 21, 2023. Last April, P&G hiked its regular quarterly dividend by 5% to 91.33 cents. Since the company's incorporation in 1890, it has paid dividends for 133 straight years, and this increase in the quarterly dividend marks the 67th consecutive year of dividend hike. Evidently, P&G's strong ability to generate cash flow has allowed it to steadily increase dividends over time. Backed by sound fundamentals and financial strength, P&G remains committed to enhancing its shareholder value. The current hike reflects a strong cash flow generation capability, driven by better execution of operating plans. We note that net cash provided by operating activities totaled $7,644 million in the first half of fiscal 2023. We believe that such strategic steps not only drive shareholder value, but also raise the market value of the stock. In fact, through these dividend increases, companies persuade investors to either buy or hold the stock. People looking for regular income from stocks are most likely to choose companies with a track record of consistent and incremental dividend payouts. Number 2. NKE. With a surge in inventories last year, Nike has been hit by challenges on the cost side, but revenue growth remains strong for the swoosh, reassuring investors that there's plenty of consumer demand for its products, even as much of the world is dealing with high inflation and the threat of a recession. In the fiscal third quarter, revenue rose 14%, or 19% on a currency-neutral basis, to $12.4 billion, which easily beat estimates at $11.5 billion. Growth was broad-based as Nike direct sales rose 17% to $5.3 billion, digital sales were up 20%, and wholesale revenue rose 12%. Also, like a lot of retailers and consumer brands, Nike has struggled with inventory levels over the past year, ordering extra products in anticipation of continued supply chain delays that didn't materialize. However, after multiple quarters of markdowns and other efforts to control inventory levels, the company seems to have brought it under control. In the third quarter, inventory rose 16% to $8.9 billion, essentially mirroring its 14% revenue growth. Although markdowns did cost the company on the bottom line, as gross margin fell 330 basis points to 43.3%, and earnings per share, EPS, declined from 87 cents to 79 cents. However, that figure still beat estimates at 55 cents. Number 3. AVGO. Broadcom Inc. saw a decent share price grow in the teens level on the NASDAQ GS over the last few months. With many analysts covering the large cap stock, we may expect any price-sensitive announcements have already been factored into the stock's share price. The stock is currently trading at $633 on the stock market, which means it is overvalued by 24% compared to the intrinsic value of $510.35. This means that the buying opportunity has probably disappeared for now, but is there another opportunity to buy low in the future? Since Broadcom's share price is quite volatile, this could mean it can sink lower or rise even further in the future, giving us another chance to invest. This is based on its high beta, which is a good indicator for how much the stock moves relative to the rest of the market. Although value investors would argue that it's the intrinsic value relative to the price that matters the most, a more compelling investment thesis would be high growth potential at a cheap price. With profit expected to grow by 32% over the next couple of years, the future seems bright for Broadcom. It looks like higher cash flow is on the cards for the stock, which should feed into a higher share valuation. Number 4. AMCOR. As of May 1, 2023, AMCOR plc had a $16.3 billion market capitalization, putting it in the 91st percentile of companies in the non-paper containers and packaging industry. Currently, AMCOR plc's price-earnings ratio is 15.5. AMCOR plc's trailing 12-month revenue is $15 billion, with a 7.1% profit margin. Year-over-year quarterly sales growth most recently was 3.8%. Analysts expect adjusted earnings to reach $0.775 per share for the current fiscal year. AMCOR plc currently has a 4.4% dividend yield. Value investors will likely look at more than just these metrics, but the above data helps show that AMCOR is likely undervalued currently, and when considering the strength of its earnings outlook, AMCR sticks out as one of the market's strongest value stocks. Number 5. ADP. ADP is a high-quality human capital management solution company that has delivered superb appreciation for shareholders over the last 3 decades with a relatively low volatility. Today, it is one of the leading and largest global providers of cloud-based human capital management solutions. Since 2013, the value of ADP stock, including dividends, has delivered returns of 14% since 1993, i.e., it has roughly doubled every 5 years, vastly outperforming both the S&P 500 and the QQQ index. The stock is up almost 30% from its December 31st, 2019 pre-COVID highs, despite the recent market pullback, which has hit tech and tech-related stocks hard, outperforming the S&P 500, but behind the QQQ NASDAQ 100 tracking ETF. In the Q2 2023 earnings call, management guided investors to a 15 to 17% EPS growth, which is slightly higher than the long-term historical total return on its shares. Prima facie indicates that the growth momentum is continuing, suggesting that absent a valuation contraction, total returns to investors will be higher than its 14% historical rate, particularly if we include the 2.8% annual dividend yield. And that's all for today's video. Remember, dividend stocks can be a great addition to your investment portfolio as they provide a steady stream of income and can help diversify your portfolio. The stocks we've highlighted in this video are just a few options to consider. Before investing, make sure to do your own research and consult with a financial advisor to determine what's right for your specific investment goals and risk tolerance. If you enjoyed this video, please don't forget to give it a thumbs up and subscribe to our channel for more investment tips and insights. And as always, feel free to leave a comment below with any questions or feedback you may have. Thanks again for watching, and we'll see you in the next video.